Long before coins, bills, or digital payments existed, people used something called barter. Barter simply meant trading one thing for another. If a farmer had extra wheat and needed shoes, he would trade his wheat with a shoemaker. But this system had a huge problem. Both people had to want exactly what the other person had at the same time. Imagine trying to buy a laptop today by offering someone a basket of apples. It wouldn't work very well. As societies grew bigger, barter became too slow and inefficient, so humans needed something better. They needed a common medium of exchange. That's where money was born. Early civilizations experimented with many forms of money. Different cultures used shells, salt, livestock, and precious metals. Gold and silver eventually became the most popular forms of money. Why? Because they had qualities that made them useful. They were durable, portable, divisible, and rare. People trusted that gold and silver would hold value over time. But carrying metal everywhere became inconvenient, so governments and banks introduced something new: paper money. At first, paper money wasn't money by itself. It was actually a promise. Each banknote represented a certain amount of gold stored in a bank vault. You could take your paper money to the bank and exchange it for real gold. This system was called the gold standard. But over time, many countries moved away from it. Today, most currencies are known as fiat money. That means money has value because governments declare it as legal tender. In simple terms, money works because people believe it works. The value of money depends almost entirely on trust. Trust that others will accept it. Trust that it will buy goods and services. Without that trust, money would simply be pieces of paper or numbers on a screen. To understand money better, economists say money has three main functions. First, money acts as a medium of exchange. Instead of trading goods directly, people use money to buy and sell things. Second, money is a store of value. It allows people to save their purchasing power for the future. Third, money serves as a unit of account. This simply means money provides a way to measure value. Money allows us to compare prices easily. Without money, modern economies would be incredibly complicated. Most people assume governments simply print all the money, but the reality is more complex. A large portion of money is actually created by banks. When banks give loans, like mortgages or business loans, they create new money in the economy. This process is called credit creation. For example, if you take a loan to buy a house, the bank doesn't hand you stacks of cash from a vault. Instead, the bank creates new money digitally in your account. This means that modern money exists mostly as numbers inside banking systems. You may have noticed that prices tend to rise over time. This is called inflation. Inflation happens when the supply of money grows faster than the supply of goods and services. When more money is chasing the same amount of products, prices go up. That's why $10 today buys less than it did 20 years ago. Inflation is one reason why people invest their money instead of just saving it. They want their wealth to grow faster than rising prices. Money continues to evolve. Today, we use credit cards, online banking, mobile payments, and cryptocurrencies. Some experts believe the future may include fully digital currencies issued by central banks. Others think decentralized currencies could change the global financial system. No one knows exactly what money will look like in the future. If you enjoyed this video, make sure to like and subscribe for more simple explanations about money, economics, and how the financial world works.